What's up, everyone? Major Tom here. I'm back, right? So let's just get right into the thick of it. So when I found myself not being able to day trade anymore, it kind of ruined my whole strategy, right? I had to come up with a new way to trade that was going to be profitable, that wasn't going to require me looking at my phone all the time. I definitely couldn't look at my phone at work, and it kind of forced me to switch my strategy up a little bit. And I want to talk about EPS trading because that's sort of how I like to swing trade now. So I stole this style from a multimillionaire trader, and I've sort of found ways to automate certain parts of the process. Now, for those of you who don't know, EPS stands for earnings per share. Every quarter, every company releases earnings per share reports, which basically tell the public if they were profitable, if they lost money, and to what degree, right? Your earnings per share is very simply just your profits divided by your total share count. So if that's in the negative, you're losing money. If it's positive, you're making money. Some of the important things to take a look at is especially on TradingView, because TradingView will actually show you where where companies' earnings per share are, and we'll show you how to do that really fast as well. So we're on TradingView right now. In order to access this, just pull up any chart and then click in the top right here. Scroll down. You'll see this little earnings dot plot. This dot plot is showing you basically how profitable the company is. This is Robinhood's dot plot. So, to put it simply, just snip this real quick. Boom. Now I can draw on it. So take a look at this, right? We're in red pen. The overall trend for their earnings is going up, which is bullish. So the stock price should be doing the same thing, correct? Well, fundamentally speaking, if this was a fair market, their stock price should be going up. So let's take a look at their performance, and we'll see if fundamentally this stock makes sense or if we can see a trading opportunity here. This yellow line that's auto-generated now by the new Major Tom algo is the fair value price at the last earnings report. So at the last earnings report, the market fairly valued Robinhood around $11 per share. Currently, Robinhood is trading at $8.62. So if we were to take a long position in Robinhood before the next earnings report comes out, since it's projected to be higher, we can make up to 38% profit or more if Robinhood returns to its fundamental value per share and exceeds it due to its better earnings. Better earnings should mean that the share price is worth more, right? Likewise, you can do this to the downside. Let's pull up Nike for a second. Nike is currently trading at $105. Last earnings, the fair value is somewhere around $82 per share, $90 per share, somewhere in that range. And the EPS is projected downwards. So let's take a look at the EPS over here. Look at that. It's projected downwards. Let's pull out our snipping tool. And let me draw on this real quick. Look at this. What's the overall trend here? It was going up, but then all of a sudden, the next earnings is projected down. And this is the next one that we need to worry about and focus on. So if the next earnings is projected down, why is the share price up? It doesn't make any sense. We now see a trading opportunity to be had. We can now capture the difference of this right here in a short position. So we see a short position opportunity cost of about 17%. And if we caught it up here at the high when it was very deflected, we could have made like 25%, right? Which is actually a lot on a blue chip stock like this, because when you're talking options, every $1 in change is $100 since you're trading with contracts. That's 100 shares. So we like to trade with contracts in my hedge fund, but you can also trade shares like this. It's just going to be a little bit slower and safer. Take a look at this, right? So we have the Major Tom algo, we have a super trend going, and now we have our fair value per share in the yellow line. We have a pretty solid idea as to what's going to happen to this, right? So we had the calls here, which ran all the way up, and then the trend started to change into a red cloud, and now this the stock's basically collapsing. So we saw like a previous support slash resistance level like right about there, and we just collapsed below it. And the overall market has been trending way down. By the way, check out that cool little IV crush symbol right there, which is about the bearish symbol the most bearish symbol you can get in trading. Pretty gnarly, huh? From that little IV crush symbol, by the way, the SPY went from 410 all the way down to 380 in a matter of like 3 days. So if you don't believe our symbols work, that's just proof in the pudding right there. But let's take a look at Nike. One of the other things that intrigued me about Nike, and this isn't just fundamentally, this is catalyst-wise, is I believe that Nike will report something in their earnings report that just about every other major clothing retailer is right now as well. So if you take a look at Under Armour's earnings and you take a look at Lululemon's earnings, they both reported a very, very bearish topic, and that is an inventory crunch. So Lululemon has a ton of inventory that they cannot get rid of even at pennies on the dollar. Same thing with Under Armour. So this is inherently like an asset loss. If you have all this asset in tangible clothing that you can't sell even for pennies on the dollar, then that's hurting your balance sheet, right? Because if you can't turn that a profit, then your earnings are going to suffer for it because you're making this clothing and you're not selling it for a profit, right? So every major clothing giant is having this issue right now, and it doesn't surprise me because we are tightening the economy and the demand is going down on all of consumer goods. So this is what's going on, right? So I predict that Nike will have inventory issues, and fundamentally they should be worth less than about, $85 per share after their earnings report. We'll see what happens. Maybe they don't get below that $85 mark, but maybe they fall $10, $12. We'll see. Another company that I'm currently very, very bearish on is Carnival Cruise Line stock. And the reason why I'm so bearish on Carnival Cruise Line stock is, if we take a look at Carnival, the earnings price was $7 and the current price is $8.45. Carnival spiked all the way up to $7.50 where we started entering in puts. And since then, Carnival stock has taken an absolute crap. Let's pull this back up. Take a snapshot of the earnings for Carnival. And take a look at this, just dissect it a little bit. So, we had last earnings here, and we're projected to be lower. Now, one of the first things that happens when the Fed starts tightening as well is people stop going on vacations. On top of this, Carnival Cruise Lines has transformed a lot of their ships during COVID into cargo ships, and they cannot pay to transform them back because they haven't made enough money yet. Carnival is also bleeding an exorbitant amount of money every single quarter because they are neck deep in debt. Now, to counteract this debt, Carnival Cruise Lines has decided that in 2023 they're going to do a share offering, which is going to decline their price per share even more. Because as you do a share offering, your EPS goes down because you're increasing the denominator of the EPS. If you increase the amount of total shares, then your profit per share goes down significantly, which is bad. So if we take a look at Carnival Cruise Lines, it looks like the writing is on the wall for this company. It looks like they're going to go bankrupt. And initially Carnival had some Saudi money come in, I believe, and buy up a lot of shares, but it doesn't look like they're going to keep getting bailed out of this. And with shares currently at $8 per share, they are seemingly on the brink of bankruptcy after this share offering. Because after the share offering, they're probably going to go down to like $6 or lower if they aren't already there after this next earnings report. And keep in mind, they have not done the share offering yet, which is going to force them even lower. We might even see the all-time low get broken of $6.18 all the way over here, right? So Carnival Cruise Lines is another one of those ones where, unfortunately, we're going to have to just hold short and make a bunch of money off of it. And it is what it is. Like, this happens to a lot of companies, and, if they want to get investor money out of basically making their stock public, then they also have to be prepared to go bankrupt by making their stock public. It is what it is. It's the game. It's the game of trading that everyone plays. And this is how we fundamentally invest at this point. We were able to capture the SPY going down before it went down purely because all of the, like, I think 75% of the Fortune 500 companies were projected terrible quarter four earnings. What did you think, that like stocks just go up regardless of fundamentals? Doesn't work like that. So the second the Fed started tightening, a lot of these companies started seeing less demand for their products, and their Q4 earnings started declining and declining and declining. As you see, there's been a lot of earnings misses in the news, which tells me that with terrible earnings coming out quarter after quarter after quarter, it's going to chop down the overall equity indexes. So if you look at SPY, if you look at NASDAQ, whatever, they're all going to get chopped because earnings are bad. And the shares of these Fortune 500 companies are being dumped. The other thing that's telling me that the market is not stable right now and not a good investment to basically get into, and you shouldn't be going long on equities, is you have Elon Musk selling out of Tesla, even more shares recently. You have Jeff Bezos selling out of Amazon. You have Bill Gates selling out of Microsoft. You have all of the Fed members selling out of their shares before they started tightening. You think all those rich people don't talk? You think they all just like gonna stay out of the market while you know there's money to be made? No, they're staying out of the market because they know the market's gonna go down even more before it corrects, and they're selling out now, which tells you like, okay, this is gonna get a lot worse. And my projections for SPY right now, and I think this is being light, is $330 per SPY share, and the SPY is directly related to the SPX. So that is ridiculous. I think that $330 is actually a fair valuation for SPY right now, given the forward projections of all these earnings per shares, and it just hasn't hit yet. I think this 5% decline in the last two trading days is just the beginning. And they're probably going to drop it very, very fast in order to set it at 330 and kind of make it so that not a whole lot of people can make money off of the put side of things, or the short side of the game. And that's why it's so important to kind of take a look at EPS and kind of determine the trend before it happens, right? So hopefully this opened your eyes to a new form of investing. Hopefully all of our trading tools can help you. And if you're interested in using any of these trading tools, go ahead and click the link down below in this video. Join the Discord. We offer the entire trading suite on TradingView for free, and you can trade with the exact same tools that I use. And the stock screener that we use is going to be going live on the International Investing webpage, which is coming out sometime in 2023, hopefully early 2023 if everything goes right. So thanks for tuning in, everybody, and just a friendly reminder, I'm back. Peace out.